interest rates, trade war, politics, investigations, Russia, Iran, you name it, it's enough to make your head spin. I thought it might be a really good idea to connect with you and share my take on things and maybe provide you with a little perspective as an investor. Let's first try to tackle the issue of trade tensions. Actually, it's a mixed bag. A month ago, there was a huge concern that a global trade war was going to break out basically between the United States and everybody else. Well, at least for now, that's not happening. I'll give you an example. In late July, President Trump and European Commissioner President Jean-Claude Juncker made nice, and they agreed to avoid mutual tariffs and a trade war. Is the same thing going to happen with China? I'm not so sure. Although it's really impossible to predict the ultimate outcome of the trade conflict between the United States and China, it's pretty clear that the current administration wants to reshape the way the United States does business throughout the world, and specifically with China. Maybe this will be resolved through negotiations, but it really isn't moving in that direction, at least right now. And the conflict could lead to higher and higher trade tariffs. Now, some pundits estimate that if the current tariffs stay in place, it could cut the earnings per share of the S&P 500 companies by 6% and slash our current GDP growth down to 1.5%. To me, that feels overstated and extremely unlikely, but still the thought of that is pretty ugly. I've said before that as a result of this fight between the US and China, the Fed may not increase interest rates as often as they plan to do. That's because the trade conflict is already slowing the economy down, and the Fed may not need to apply their own brakes via interest rate increases. For a minute, let's try to understand what the hoopla is all about with regards to this trade war between the United States and China. Well, China sells us over $460 billion worth of goods, and we sell them about $115 billion worth of stuff. Of course, American producers would love to sell more to the Chinese, but they find it difficult to do so because of restrictive Chinese government policies. Now, this trade imbalance frightens some American leaders. They're afraid that China will continue to gain control over U.S. assets and possibly be in a position to weaken our currency. To make matters worse, there's this issue of intellectual property theft. And it's been going on for years within China, to the detriment of the United States. According to CNN, we lose about $225 billion every year to China alone due to this issue. And so far, the American and Chinese governments have failed to come to an agreement on how to stop this from going on. In short, there's a lot at stake right now, and this is why trade is a huge concern for both sides. The good news is that there's a lot at stake for both sides. They both have significant incentives to come to an agreement. And as a result, I think it's unlikely that the current strain with China will turn into an out-of-control trade war. But it's not a guarantee. It could happen. The trade standoff could gain momentum. And if the tariffs continue or get ratcheted up, it will hurt domestic corporate profits. It'll add to inflation and hurt employment. And if it gets really ugly, it could lead to a recession. Obviously, I'll be monitoring the situation very, very carefully. Let's talk about the dollar. The American dollar is very strong right now, relative, of course, to other currencies. And that often happens in times of uncertainty. I don't want to turn this into an economics lesson, but let's just say that the strong dollar is making waves all over the world. economically and politically. The strong dollar alone probably won't push the world into a global recession. But it does tighten the screws a little, and is also something very much worth paying attention to. I want to talk about real estate. Real estate is interesting. What seems to be happening in many real estate markets is that rents are falling while property prices continue to rise. Now, to me, that signals speculation. And part of what's fueling the speculation is that a handful of banks are making very risky loans. Some irresponsible lenders are able to offer loans up to $3 million with only 10% down. And to add fuel to the fire, they're making loans without giving much weight to a potential borrower's other debts or even their FICO scores. Now, it reminds me of the mid-2000s, doesn't it? Yeah. Now, this bad lending practice isn't nearly as widespread as it was back then, but it's still dangerous. So, in my opinion, real estate could be vulnerable. And this is especially true in places where real estate prices are high, such as in the Northeast and in California. Those expensive properties become automatically more expensive and therefore less easy to afford as soon as the income tax law changed, making it difficult to fully deduct the state, local income and property taxes. That's why I think property prices could decline or stay the same a long time, especially if interest rates climb. How far could real estate prices drop? Well, that's impossible to predict. And if rates go up quickly, home prices could take a bigger hit. If rates only go up modestly and incrementally, prices may not drop at all, but just may stay stable. Also, the government could come in and clamp down on those wild lenders I spoke about earlier. Now, that would be a very good thing, but of course it's something that we have no control over. You know me, I don't like to make predictions, and I'm not predicting a real estate meltdown, not in any way. But I do think it's probably a good idea that you use caution right now, and if you're buying property that you can afford, and you're buying it as a long-term investment, I think that's fine. It could be fine. But if you're planning on selling property in the near term, you might consider doing so sooner rather than later. Just an idea to think about. Let's talk about inflation and wages. Inflation right now is 2.9%. It's not too bad, but it's high enough to keep the Fed raising interest rates as planned. Wages are also up, but they could be slowing down. What's important to watch here is what happens to the inflation rate and the unemployment rate, currently at an extremely low 3.9%. Now, if employers find it more and more difficult to find workers, we might see wages and inflation spike up. On the other hand, companies are already using more and more technology to replace labor instead. There's simply no way to predict what's going to happen over the short term. What's more important is to watch what does happen and then take action if required. But inflation and wages are something I'm going to continue to watch. Now, is there any reason for optimism? Absolutely. There's a lot of really good news. The economy is growing like nobody's business. It's growing over 4% right now, which is the best since 2014. Jobs are plentiful. Income is up, and so is optimism. According to Investor Business Daily, economic optimism rose to 58, which is the highest it's been in 14 years. There's no doubt that Americans feel really great about their own personal financial situation. And of course, that leads to more spending and more investing, and that's good for investors. The factory index is over 60, where anything over 50 signals growth. And the current level is the second highest it's been since 2004. Supplier deliveries is up to 69.2, and that's the second highest since 1979, which is the year I graduated in college. New orders index stands at 63.5, and production gauge is at 62.5. Both of these are great numbers signaling a lot of strength. The bottom line is, like always, there are different forces pushing and pulling on the market and on the economy. Right now, the situation seems pretty solid, but there are ample threats. I'll continue to carefully monitor this, and I'll make changes in our portfolios as required. If you have any questions, or you'd like to talk to me and discuss your portfolio in light of what's happening right now, please call Kim in the office and she'll set up a good time for us to meet. 818-889-6700, extension 3. Enjoy the rest of the summer. Thanks for your time. Be well.